Good morning, guys. Hope you're all well. Looking forward to the session. I know it's going to be a good day today. Something's happened to me that has never happened before in my life, and don't judge me, but it's to do with Starbucks. And what's actually happened today, for the first time ever, if you can see that, Starbucks spelt my name right. And I promise you it's the first time ever in history. So, you know what? Today is going to be a good day. On lesser important things, let's talk about what's going on out there. We got some interesting stuff. Let's talk about markets in a minute. I want to just talk about a couple of things that's happening today that is of interest. Here's a picture. So Trump's going to meet his first foreign leader today. Abe is in town. He's in New York, and he's going to be meeting up with Trump. So this is actually officially the first foreign leader. You might say that, hang on, he's already met Nigel Farage, but Nigel Farage is only a country's leader in his dreams. So this will be the first national leader. The thing that's interesting about this is, well, it's actually what the Bank of Japan did last night and what it means for the US. Here's a chart of 10-year government bond yields in Japan. Now, I mentioned this earlier in the week. 10-year yields up through zero for the first time, as you can see on the chart. I mean, we've made a new, well, you've got to go back to February 2015 to find the last time yields were this high. I use the word high in inverted commas. So up through zero. And of course, the Bank of Japan have a policy that they rolled out, a new policy just a few weeks back, that they would defend this. They would cap yields at 0%. They would pin 10-year yields at zero. And so, you know, I guess not in their worst nightmares did they think that they would have to start to act and kind of try and engineer that scenario so soon. But how do you cap yields at zero? Well, you've got to buy bonds. Buy bonds, of course, prevents price from dropping further, because obviously yields going up here, that's prices falling. So if you're buying these bonds, propping up the price and keeping the yield below or at zero. Okay, so here we are, and actually the Bank of Japan yesterday did set out their stall and their intent to act and keep this ceiling by rolling out a commitment to buying, well, actually they were buying more shorter end of the curve, 2 to kind of 5 years, but anyway, it signaled that they do have an intent to kind of keep this yield ceiling in place. Now, what is this? Why might this be important for the US? This is quite an interesting argument that's being put forward. If you've been reading your early morning reads, then they've been mentioning this the last few days. So I thought I'd just talk about it and maybe explain it if you'd not quite understood it, because what this actually could mean, and the way Deutsche are kind of talking about it in a more kind of sensationalist way, is that this really potentially is kind of helicopter money for the US. Because what's Trump's plan? Well, his plan is to roll out a massive stimulus program. That's going to result in the US deficit widening. It's going to result in the US having to take on more debt. So that means that ultimately there's going to be more supply of US debt, which means prices drop and yields go up. Secondly, if his plan is successful, this fiscal stimulus should lead to inflation, which should also lead to long duration bond yields rising. Okay, now here's an interesting idea. If Abe is maintaining Japanese 10-year bond yields at zero, well, then actually what this leads to is, on a relative basis, yields in the US become more attractive because yields are on the up. So actually meaning that foreign investors or just global investors would more prefer to buy US bonds, because there aren't any other bonds globally that carry any yield. You're not going to buy Japanese bonds at zero when you can buy US bonds at 2%, for example. So this should lead to an increase or a higher demand for US bonds from global investors than would otherwise be the case if Japan weren't suppressing their yields at zero. What this should in turn lead to is then US yields being kept low just by global demand from investors. Buying bonds, prices go up, yields go down. So do you see what I mean here? Japanese monetary policy could actually be a situation that forces US bond yields to remain lower than they ordinarily would have done, making this fiscal program that Trump wants to roll out cheaper to fund if borrowing costs remain low. So this is quite an interesting situation, and if you like, it's well, as they're describing it, it's effectively Japan buying assets in order to make borrowing cheaper for the US government. So you could say it's Japan directly financing the US government. Okay, that's the kind of thought process here. Whether this is going to be a topic for debate when these two meet this afternoon, we'll have to see. But it could well be. And, you know, we don't know the schedule really, but we don't know whether there's going to be any comments before and after this meeting. But certainly an interesting one, and the kind of first notch on the bedpost for Trump with regards to meeting global leaders. That's one thing I wanted to talk about. The other thing that's kind of been gathering a bit of momentum, or has been getting some press attention, is this the risk. Obviously, we've been talking about Trump and his policy mix. And actually, now I've just said that, just give me one moment. I want to just bring up a slide with his policy mix on. This will be 1 second. Because he's got obviously different policy ideas, some of which are considered to be negative and some of which are considered to be positive, of course. So here's the screenshot of his kind of policy. You know, the different kind of policies, the fiscal stimulus idea, and then this is, well, this is you know, being considered as a potential positive for economic growth. Tax cuts, potential positive. Reducing regulation, the regulatory burden of the financial industry, leading to perhaps more credit availability, potentially a positive, right? But then you got all the negative stuff, forcing the Fed to be more hawkish, and we'll talk about that in a minute because Yellen's talking today, and we're really going to start to think properly about 2017 rate trajectory. So this will be interesting. So I'll talk about that shortly. But the one I want to talk about is the trade risk, Trump trade risk. So you can see here one of the bullet points on the slide. Trump to get tough on China and slap 45% tariffs onto Chinese imports. So here's the situation. Trump is not happy and thinks that China have been really cheating the system and have been manipulating the their exchange rate, manipulating or forcing the yuan to remain much cheaper than it should be, and therefore enjoying the benefits from a competitiveness, you know, point of view in the kind of global manufacturing exporting game. So here's Trump's beef. What's happened is, because of China's emergence and because of the cheap currency and therefore the cheap labor, Trump thinks that this has had a directly very negative effect for middle America. Well, it's hard to judge, but they reckon about 13 million jobs, US jobs, have been lost to China in the last 20 years. That's as companies offshore their manufacturing to China, okay, at the expense of manufacturing jobs in the US. So they reckon 13 million, and about 3/4 of those 13 million are manufacturing jobs. So this is really hammered, you know, middle America. It's that kind of white blue-collar worker. These are the guys who voted for Trump. This is the problem. Trump's key support demographic are going to now want to see action on China. The problem is, of course, if Trump riles China and slaps a 45% tariff on their imports, well then China potentially have a very, very large retaliatory weapon. That very large retaliatory weapon happens to be the fact that they own upwards of $2 trillion of US bonds. If China really wanted to, they could create absolute disaster. If they wanted to, they could retaliate by selling US bonds. Selling bonds, of course, driving yields sharply higher, making it incredibly expensive for the government and corporate America to borrow money and actually force a recession. China do have the power to create a US recession if they wanted. So here's the two sides of the battlefield. The only problem, of course, is that if China did that, well then not only would the US go into a recession, but actually the whole world would go into recession. And actually, who would be worse off if the globe had a recession? Well, it'd actually be China. So actually, even though some commentators are saying China have got this weapon that they're going to use to prevent Trump, or threaten to use to prevent Trump from increasing tariffs, China don't have a weapon. Because ultimately, if they dumped a whole bunch of US bonds, actually in the end, China would be worse off than America as a result of a global recession. So it'll be interesting to see how, given the demographic, or the key demographic that voted for Trump, and Trump's kind of sense of responsibility to deliver on their behalf, I think the trade risk is a very live one, and the trade agreements, well, not only with Mexico, of course, and potentially Canada, but what's going to happen, what's Trump going to do with China is one of the big risks for 2017, I think. Okay, let's switch and talk about the calendar for today. So let me bring up the economic calendar here, and again, quite quiet, I would say, on data. We've got retail sales out of the UK. This is coming at 9:30, which is really probably the most interesting number of the morning. We do have European CPI, but this is final readings. We've already had a preliminary reading for October. That was at the start of November, and the preliminary reading was 0.5% year-on-year inflation for October, and we're expecting that to stay the same. If you just had a look quickly at the chart of that, I mean, inflation is definitely going to become a very important sorry, that's the wrong... Sorry, hang on. That's the wrong chart. One sec. Inflation's going to really become a very important data point in the months ahead. You know, just how fast is inflation going to rise? You know, have we put behind us this period of low, record low inflation or even deflation? And are we now seeing the long road back to an inflationary environment? So 0.5% here was notable when it was announced at the start of November, because it was the highest reading. And if you go to a 5-year chart, it's the highest reading since 2014. Okay, so you got like a 2.5-year high on inflation here. So we'll keep an eye on that. But it's the final reading, and it's not likely to be different to that reading they delivered a couple of weeks ago. If we just looked quickly at the UK retail sales chart, let me just scroll down quickly. Then we're looking for, well, look, we've had 2 readings of 0. Let me just go back to the economic calendar to get the forecast on that. So we're expecting 0.4%, okay? So we're expecting the UK to return to retail sales growth. We had this giant leap in July as the collapsing pound right in the holiday season led to a lot of, well, an increase in tourist spending here in the UK. But then it's been flat and flat, and so we're hoping for a little tickle higher here and a return to positive retail sales growth. So this will come at 9:30. Just quickly have a look at cable as we're talking about that. You know, we've had quite, well, it's been a difficult one for cable because the dollar's been strong. And we'll show, well, let me show you on the euro dollar chart here. I mean, the dollar made, of course, a new, well, what is it, 12-month low effectively yesterday, and look where we're trading right now, right back on this January low. So we broke the 107 handle briefly last night as this dollar rally continues. But the issue is it's a really hard, you know, when you've got a strong pound and a strong dollar at the same time, of course, it just makes it pretty tricky to judge direction for this exchange rate. And so it's been pretty messy, I would say. But, you know, we've been on the up this morning so far. We're testing a bit of resistance on cable that we had, which is yesterday afternoon's high, 124.80 on the futures, and, you know, strong retail sales numbers, and we'll look for a push to 125, and then you're getting some resistance up here at the 125.09 area. Yesterday's high 125.22. That's the high into the close off the back of that Supreme Court rumor back on Tuesday evening. Okay, but at the moment sterling on the up. Do be careful, of course. We mentioned about data getting leaked, and it looks like we're in for a strong retail sales number. The skeptic within me looks at this and says, well, all right, looks like we've got good data coming, because we've had a decent rally here this morning. Let's go back to the calendar. What else have we got? That's pretty much it for the morning. Retail sales and then the CPI number from Europe. Into the afternoon, we've got CPI numbers from the US, expected to edge higher to 0.4%. And yeah, core, let's just have a look at that chart on the core CPI for the US year on year. We're expecting it to rise to 2.2%. I mean, core CPI has been... hang on, it's already at 2.2%. They got it wrong on that chart. So this has been very flat for 12 months now. So, okay, as long as it comes in line, I guess if we get a 2.4% print on core CPI, then that'll be notable. That'll be a new high for the last few years. But we've got jobless claims, we've got housing starts, building permits, Philly Fed number. So quite a busy batch of numbers all hitting the wires at 1:30 p.m. Then focus switches to Mrs. Janet Yellen. So she's going to be talking at 3 o'clock. We are expecting a text pre-release at 3. So she's in front of the select committee talking about the economy. It'll be the first time we've heard from her since the election. We're pricing in a 94% chance of a hike from the Fed in 4 weeks' time. And let's see what she's got to say. I think now, as I said yesterday, it's not really about December. They're going to hike. It's more about, well, what happens in 2017? And if you had a look at this chart here, obviously since the election, things have shifted. And actually in the opposite way than we really thought would happen pre-election. And things have shifted because now we're actually thinking interest rates are going to have to go up faster next year than we thought they were going to have to, even if Clinton had won. And that's because of this fiscal stimulus plan of Trump's. If he delivers it effectively and it drives growth up above 3% and inflation starts to climb, well then the Fed and rates start to climb, then the Fed are going to have to act faster. So actually we are looking at potentially a steeper interest rate hiking gradient from the Fed for 2017. This blue line then is the Fed funds futures pricing in the level of interest rates as we go into next year. You can see the purple line is what that looked like before the election, November the 7th, the day before the election, when we were expecting a Clinton win. So we've definitely had a steepening of the Fed funds futures pricing of how we see Fed interest rates changing next year. Okay. So Yellen at 3, probably the most important event of the day. Well, not probably, definitely. Well, unless something alarming comes out of the Abe-Trump meeting, and you never know with Trump, right? So let's see. Right, let's go to the charts just to finish off. Let's just look at bonds, because I want to look at 10-year yields here, which have just been on the up this morning. So we've just taken out the overnight high. So new high here, and this was the resistance from yesterday. Yesterday's double top for T-notes futures at 126.22. That was the top at 1 a.m. overnight, and we've just taken that out. So moving higher. This is continuing the rebound. So this is yields dropping back a little bit. Target on the upside from here would be the high of the, well, not the week, Tuesday's high at 126, or the 127 handle, let's say. Okay, so bond yields on the up, and if you look at German bunds here, similar kind of scenario as you're getting prices rise. So the Bund has just actually made a new high for the week here. T-notes not new highs for the week at this point, but the Bund's certainly leading that. So just a little bit of respite. Having had a very steep sell-off on bonds globally, we're now getting a little bit of a pushback higher. But I would say, you know, this isn't... Let me go to a daily chart here for the Bund. You know, I would say this isn't the end of the bond market sell-off, in my opinion. This is just a little bit of a pullback, a temporary pullback. And I think that this downtrend that's really been in place for a couple of months now, I think will be ongoing. And so pullback resistance for Bunds at 161.37, which was the October low. Just on T-notes, looking at a daily chart, if we go to daily continuation, then we're definitely relatively further lower, but it's hard to, I don't know, it's hard to get a resistance level here. Certainly from a support point of view, we didn't quite make it to the December low from last year, but on the pullback, maybe that 127 handle is the level. There's not really that much else unless you get right up to 128.16.5, and that was the low point we had mid-March. So maybe this 127 handle is actually pretty important from a resistance point of view. Elsewhere, I mentioned currencies, and what was notable about the euro-dollar's move was the fact that we did make a new low for the year yesterday. We have bounced here, so we're just getting a little bit of a lift as I've been speaking. Euro-dollar's just made a new high for the session, up to 107.40. On the upside, yesterday's highs 107.73, maybe something to look for. But this is just, you know, price action really. There's no news flow particularly that's driving things this morning. This is more of just a bit of profit taking after that continued extension lower from yesterday. Let's just perhaps finish on oil, which was a difficult one yesterday. If I just draw a couple of lines in here. Ultimately, we had some inventory data that was very bearish, and ultimately we went and made a new high. And that's because we had contradictory influences in the shape of comments from Russia, the Russian energy minister Novak saying that he thinks that OPEC are going to cut production. But then you also had the US production number announced at the same time as the inventory data that showed that US production had dropped marginally. It was only a tiny drop though. Anyway, in the end it confused matters, and all we got was a mess. Rather than what we perhaps thought we might get, which was a break below 45 bucks, especially with dollar strength going on at the same time, we actually didn't have that. And here we are now, we're just bang in the middle of this mess from the last couple of sessions, trading around 45.50. So a bit directionless here at the top of what has been a huge rebound earlier on in the week. So we'll see. OPEC headline risk definitely still right in the mix, and it will be the case now until the 30th of November when we get the actual OPEC meeting. So keep your ear to the ground for OPEC comments, okay? But for now, oil seems quite content up here despite those bearish inventory numbers from the US yesterday. Right, that's it. I've spoken enough. Data-wise, next up, well, we've got some stuff at 9, but that's not important. So really 9:30 UK retail sales, and then we go from there. But the big event of the day, Janet Yellen, and perhaps Trump Abe. All right, guys, that's it. Enjoy the session. Bye.